Hello, everybody. I'm Mickey Payne, the Vice President of Investments at WMBC. Today, I'm excited to present our first quarter market commentary. We hope you enjoy it and eagerly anticipate any feedback you might have. We're committed to providing you with information that we hope you will find valuable. In this quarterly market commentary, our goal is to update you on key highlights in the economy and the changes that took place in each of the investment models during the last quarter. So, without further ado, let's get started. Before entering 2024, two questions dominated investors' minds. One, could the Magnificent Seven, which consist of Alphabet, Amazon, Apple, Meta, Microsoft, Nvidia, and Tesla stocks, continue to rise and support the market rally? And then two, will the Federal Reserve lower interest rates in March? Well, as we sit here at the end of the quarter, we have the answer to those questions. First, the majority of the Magnificent Seven tech names have continued to push higher. However, Apple and Tesla are significantly negative for the year. This seems to be the beginning of a welcome sign for a healthier market dynamic, as we have seen gains more broadly spread across stock market names. And then second, the Fed did not cut rates in March, but continues to support the case for 3 rate cuts this year. Unlike most historical episodes where the Fed is not considering cutting rates because the economy is too weak, instead is doing so because inflation is heading in the right direction, and there's no longer a need for such a restrictive policy. If the Fed is right and can engineer a soft landing, which means decreasing inflation after increasing interest rates without causing negative GDP growth or an uptick in unemployment, then 2024 could continue to be a good year for both stocks and bonds for investors alike. So in this chart, you see the unemployment rate going back to 2014. You'll see that the Federal Reserve is watching the initial claims for unemployment benefits. Though the economy grew more slowly than expected over the first quarter of 2024, the labor markets remain strong with relatively low unemployment rate overall and across groups. The national unemployment rate rose slightly from 3.7% to the previous quarter of 3.8%. However, California and Nevada had the highest unemployment rates at 5.3 and 5.2% respectively. So another indicator we look at when we look at the economy is how consumers are spending. Personal consumption expenditure, which is PCE prices, increased 3.4% in the first quarter after increasing 1.8% in the fourth quarter. Excluding food and energy, the PCE core price index increased 3.7% after increasing 2%. The increase in consumer spending reflected an increase in services that was partly offset by a decrease in goods. Within services, the leading contributor to the increase were healthcare as well as financial services and insurance. Within goods, the leading contributor to the decrease were more motor vehicle and parts as well as gasoline and other energy goods. The increasing housing investments was led by broker commissions and other ownership transfer costs, as well as new single-family home constructions. The decrease in inventory investment was led by decrease in wholesale trade, as well as manufacturing. Compared to the fourth quarter, the deceleration in real GDP in the first quarter primarily reflected deceleration in consumer spending, exports, and state and local government spending, and a downturn in the federal government spending. These movements were partly offset by an acceleration in housing investments and imported acceleration. Last year was a good year in the markets. This chart reflects the one-year total return after the S&P 500 index reached a new all-time high. You'll notice there was only 1 year we had a down year, and the rest of the years we had an average return of 17.1% afterwards. The WMBC quantitative model is designed for risk-managed performance over the long term by using several technical indicators. We review these indicators daily to tell us whether we should be in the markets or out of the markets and bonds, or minimally or maximally allocated to equities. These indicators' primary focus is to identify a high probability of disturbing the markets, with the primary focus to help protect you from the potential downside in the markets. So, in Q1 2024, the equity side of the model remained in maximum equity allocation, while selling the iShare S&P 500 Value ETF and the iShare Dow Jones Industrial Average ETF, and using those proceeds from the sell to reallocate to the iShare S&P 500 Midcap 400 Growth ETF and the SPDR S&P 500 Midcap 400 ETF. For the bond side of the model continued to call to be invested in bonds. So, as a Treasury security matured, we bought the iShare Aggregate Bond ETF. As you may or may not know, another benefit of buying Treasuries is the interest on the Treasury securities is exempt from state but not federal income taxes. The WMBC Strategic Hold Portfolio is designed to help investors pursue long-term investment success through fundamental research by the American Funds team. American Funds research includes thousands of face-to-face meetings with companies throughout the world. They visit factories, facilities, and headquarters to help drive deep operational understanding and inform portfolio asset allocation. A long-term approach coupled with extensive fundamental research has allowed American Funds to generate strong results versus their peers. In Q1, there were no reallocations that occurred. There are several model portfolios using these strategies. First, the American Funds Growth Model Portfolio. It had a robust absolute and relative return for the quarter. U.S. and non-U.S. stock selection lifted results for the quarter, especially in the information technology, U.S. industrial, and communication services. U.S. healthcare selection was a relative detractor. The Growth Fund of America and Fundamental Investors had the strongest relative underlying fund returns, while Small Cap World Fund and New Perspective Fund detracted on a relative basis. The second portfolio is the American Funds Growth and Income Model Portfolio. It had positive absolute and relative gross of fees results for the quarter. Although net return trailed the benchmark, stock selection in the industrial and consumer discretionary sector boosted relative returns. Limited allocation to an electric car manufacturer and a consumer electronic company also helped. Limited sector allocation to fixed income supportive relative returns. Selection in corporate and scrutinized fixed income helped to counter negative selection in the treasuries over the quarter. American Funds Retirement Model is a third model. Mostly outpaced their benchmark for the quarter, except returns for the American Funds Retirement Income Model Conservative, which lagged. Significant exposure to equities helped the quarter, even though dividend-paying equities across the globe trailed. Two quarter building blocks, Capital Income Builder, and the Income Fund of America both had meaningful concentration in higher yielding dividend payers. Fixed income contributors were mixed. High yield credit exposure helped while U.S. Treasury detracted. American Funds Multi-Sector Income Fund was a positive relative contributor in all three models, while American Funds Strategic Bond hurt on a relative basis in the moderate and conservative models. And the last is the American Funds Preservation Model. It had positive absolute relative gross of fee returns through net returns were negative relative to the benchmark. Selection in securitized debt and corporates outweighed negative selection in treasuries. The WMBC LTAM portfolio is an active management portfolio strategy that shifts the percentage of assets held in various asset class categories to take advantage of market pricing anomalies or strong market sectors. This strategy allows the portfolio managers to create an extra value by taking advantage of certain situations in the marketplace. While maintaining your long-term investment approach, managers return the portfolio to its original asset allocation once reaching the desired short-term profits. So in Q1, there were no changes in equity as well as fixed income. The WMBC Alternative Model is an actively managed multi-strategy alternative investment portfolio. Our model seeks to provide you with access to unique investment opportunities that produce returns with a low correlation to traditional investments. We have two alternative models. The WMBC Alternative Income is more focused on generating income, while the Alternative Growth Fund is more focused on generating growth. The alternative model is currently made up of institutional access to commercial real estate and institutional access to a diversified portfolio of credit instruments, and a hedge fund that is focused on long and short equity investments. In Q1, after extensive research and discussion, the investment committee agreed to invest the cash into Treasury securities for now. We continue to look for opportunities, but take a conservative approach as the market digests this year's quantitative easing by the Federal Reserve. We hope you enjoyed this format. If you have any questions regarding your investments, feel free to contact us. Thank you for the opportunity to serve your investment needs.